Evening.
Hello, hello, hello. Can everybody hear me?
Good evening.
How is everyone?
Recovering. I'm good.
Recovering.
Yes, I was sick.
What?
Mm-hmm.
Not with that thing, I hope.
Well, I took about 4 tests. I had every symptom of it. So I was convinced it was it. and
Uh,
the four tests said negative. So
but
I
you
don't know.
still feel the blah, blah, blah. A little bit.
I felt horrible.
Yes,
Mm,
if it was anything with like flu-like symptoms,
yep. Mm-hmm.
um, the fact that they came up negative, hopefully you just had the regular flu symptoms,
Mm-hmm.
because nobody's talked about the flu for the last 18 months for some reason. I don't know. And the flu on holiday. First time in my lifetime that there's never been a flu season.
Mm-hmm.
Some strange reason.
Mm-hmm.
Interestingly enough, even the experts at the CDC and the CNN people are always coming up with the study bits and pieces and others. Nobody said anything about the common cold these last 18 months.
No, they haven't.
I wonder why.
Everything is COVID.
Yes, Ejika, everything is COVID.
Mm-hmm.
Some strange reason.
Mm-hmm.
But if you're feeling any better, I'm happy to hear that. The fact that you're here with us is a big deal. So welcome aboard. Perfect.
Thank you.
Since you mentioned that, let me just say that unfortunately, Susanna rolled. You guys remember Susanna from the last two sessions?
Yes.
Yeah, Susanna came up with something as well.
Oh wow.
She's trying to figure out what it is, but whatever it is, it has put her life on hold for some reason. She's had to just back off, and the doctors put her on don't do anything, including class.
Wow.
So yeah, yeah.
Wow.
So the fact that you're up and kicking a little bit at Trika, you're way ahead of the game. She won't be
Wow.
doing this anymore this semester because of whatever.
Wow. I pray she gets better.
Yeah, absolutely. We have to continue to be as careful as we can.
Mm-hmm.
Hey, this crazy time. Okay, so let me just do my register first before we begin. Natasha, are you there?
Good evening.
Evening, Natasha. Uh, Andrika.
I'm here.
Okay, great, Andrika. Hmm, I don't think Davina is joining us for some reason. Something happened. Dominique, something happened there. Okay, Tanika, something happened there. Okay, Adrika's here.
I'm here.
Fortunately, Cheryl, are you there? Cheryl, guess Cheryl will be joining us shortly. Susanna, unfortunately. Jerry, I see you there.
Sir.
Wonderful, wonderful. Welcome aboard. Are you still married, Jerry?
Yes, I am.
Why did you ask him that?
I'm just teasing him because he's a young married guy.
Oh,
I guess a lot could change in a week.
Of course,
happy being married, Jerry.
Thank you very much.
he survived another week.
Wow.
Okay.
Congratulations.
A very big deal these days, okay? How long have you been married again, Jerry?
This month would make 6 months.
Wow.
Yeah, you're still on
You're
honeymoon.
newlywed. Wow.
Yeah.
Okay, then I take that statement back. That doesn't apply to honeymooners.
Okay.
That doesn't apply to honeymooners because you're not going to really get it till like year three or something.
Yeah. Okay.
So
That's a good length of time. All right.
yeah, we'll see what happens in year three. But for now, you're not responsible for anything you say because you have no idea what you're talking about. So enjoy the honeymoon, Jerry.
Yeah, man. Definitely.
Yeah, keep it going as long as you can.
I'm trying my best.
I'm just teasing you. Uh, uh, it could be a wonderful thing. You just keep working it and hope things go according to schedule. Okay. So far, so good. Way to go. All right. What about that homework? How did that go, everybody?
Is it due today or Saturday?
Saturday, just throwing in an early question. If it's finished,
Oh, okay. It's going okay.
you can take, well, you were not all that hot, so yeah, you need to take it to the last minute. Yeah, it's due on Saturday.
Okay.
Does anybody have any questions about it that they want to raise at this point, or you just want to go ahead and finish and then we go from there? Okay, that's fine. As of course, if you have any questions, you can raise them at any time. Um, your course outline, I'm almost done with it. However, I can tell you at this point, well, first of all, let me ask the question. Our midterm can be on one of 2 days. Please take note. We can have
Okay.
our midterm on August the 12th, which is the Thursday from 6 to 9, and then speed home before curfew. Or we can have it on August the 14th, which is that Saturday morning from 9 to 12.
I'm feeling the
I'm feeling it Thursday.
One
What?
Thursday.
I'm feeling that Saturday because you don't want to speed home from curfew. Also, the 14th is pretty quick. So if that extra 2 days can help,
Yeah,
Aha.
the 14 sounds good.
Okay, so that's 2 for the 14th, 1 for the 12th so far. That's 3. Jerry?
I'm fine with either.
Sorry?
I'm fine with either. Either.
Doggone it, neutral.
I know, right? I didn't want to be that guy, but
You don't want to pull us around the fox and okay. So he'll go with either one. So I wonder what either one means. Is that Saturday or Thursday? It just means either one. All right, so since he's neutral, that's 2 to 1. So it looks like we're going to have it on August the 14th. All right, so please make a note of that.
Okay.
The good thing about August the 14th is August the 12th gives us an opportunity to answer any review questions you might have. All right, because remember for this week we'll be covering partnerships today and on Saturday, and then for next week, August the 5th and August the 7th, please, you are required to read for chapter 11. Please make a note of that. Chapter 11 in your textbook. I think that has to do with liabilities, yes?
Yes.
Okay, so that's your schedule for the next few sessions. The midterm will be on August the 14th from 9 to 12. That will be in-house at Institute. We will use that week before, that period before the 12th, that Thursday, to finish up any bits and pieces from chapter 11 that we may not have covered, and to answer any questions from any of the 3 chapters that you might have going into your midterm exam on the 14th. So that's the good thing about that. All right. Hopefully I'll finish typing up your course outlines another day or so and email them to you so that you can see the remaining of the semester schedule. All right. Any other housekeeping items? Homework is due on Saturday. I will assign homework for partnerships on Saturday's class, and then I'll assign homework for liabilities next week. All right, so on Saturday, I'll assign partnership homework after we're done with the chapter on partnerships, and then next week I'll assign homework for liabilities. And again, this is just designed so that you can practice this stuff. Accounting without practice is a nightmare. You still have to do your reading and remember the important concepts and all that stuff. Don't wait until the last minute. You remember your exam is week after next, but that time will go quickly. Because after we're done this week, then we only have next week to do liabilities, and then after that will be the exam week. So please take advantage of these weekends, catch up on your reading, make sure you try to remember as many of the important concepts as you can. Remember, you don't have to remember them word for word. Just do the, however you study the important stuff. The details is just for information. Stuff is what you try to remember. Because remember, your examination is going to be definitions, short answer questions, and problems. Okay, so that just means focusing on the important stuff. All right. So if there are no questions, let me see if I can get my notes up here. Remember, you can raise questions anytime you want. Feel free to do that. All right, so let's just get right into partnerships then. What chapter is partnerships in your textbook, anyone?
Chapter 12.
Chapter 12. All right. Remember those statements I gave you at the beginning? Did I say I might test you on them?
I think you did.
I think I did. I said you should know those 4 statements just in case. If you know them and I don't ask anything, then you know them because you need to know them. If you know them and I ask, then you get some easy points towards your final grade. All right. Can somebody tell me what the formula is for the income statement?
Expenses minus revenue.
Actually, it's the other way around,
Okay.
which would be
Revenue minus expenses.
equals,
Your net income.
correct. What happens if expenses are greater than revenues?
Net loss.
Expenses, you're at a loss.
Yeah, net loss, okay? What about the statement of equity? How do we set that up?
That's beginning equity balance plus
Beginning
net
equity?
income
Yes,
minus withdrawals equals ending balance.
indeed, indeed, indeed. What about the formula for balance sheet? How do we set up the balance sheet?
Would that be the total assets equivalent total liabilities and capital? I mean, the total assets would equal the liabilities plus capital.
Absolutely. That's your balance sheet. Remember, when you set up your balance sheet, the assets go to the left side, the liabilities and capital go to the right side. Together, liabilities and capital must always equal your assets. If they are not, your balance sheet will not balance and you did something wrong. And then the final important statement, the statement of cash flows, how do we set that up? What do we start with?
I think it's operating activity.
Yes. Plus. Plus.
I'm not too familiar with that one. I have to go back and study.
Okay, that's okay. You said the right thing. You have to go back and study it. That's the key.
I can recite it from the notes I have.
Yeah, recite it. I don't mind.
Operating activities plus investing activities plus financing activities equals change in cash plus beginning cash balance, which also equals ending cash balance.
Indeed, indeed. And it's okay if you have to recite it a few times. That's how we learn things. Since you're newlywed, you'll find that your wife will ask you to recite certain things more often than you might think is necessary, Jerry. Like, Jerry, do you still love me? And you're like, we've only been married 6 months. Of course I love you. Something like that. She said, and then you said, why did you ask? She said, I just wanted to hear you say it. See my point?
That's always the reason. Yeah.
Yeah, it's like that. So if you want to be good at it, you just have to keep studying it until you get it. There's no secret. All right. So don't be bothered if you have to go back and review it and review it and review it. That's exactly what learning is all about. The pain and suffering of over and over and over. Okay? Without Without that, we're in trouble. All right. Remember, this class is an interactive class. You can raise questions anytime about anything. So even though I'm talking about partnerships, if you remember something in chapter 10 from long-term assets, excuse me, this is chapter 10, I have a question that's remembered. You can do that. Okay? You don't have to wait. All right. So then this chapter talks about the various characteristics of the partnership form of business. Does anybody remember the three main form of businesses from previous accounting or otherwise?
I know sole proprietorship is one.
Yes.
Partnership is that another one?
Yes, it is.
And corporation.
Yeah, corporations, the third one. Absolutely. Those are the major forms of business out there in the world. Most businesses are either one of those three or some variation of it. Of course, in the second half of our semester, we'll be looking at corporations, which is the third part, and perhaps the most complex of the three. Because remember, the sole proprietorship is the easiest one. You can start it very easily, just get some money, buy your stuff, and start selling stuff, anything from coconuts to whatever you want to sell. All right. We have some guys who've been walking around. They're not buying their inventory. They're going into people's yard and stealing it off the tree. So if they see a coconut tree, they run into people's yards, steal the coconuts, and sell them, which means that their profit margin is going to be higher than the person who has to buy the coconuts. Correct? Correct?
Correct.
Yeah, because if they didn't have to pay anything for them, then they're going to make more money when they sell them because they didn't have to buy them. Okay. Of course, stealing is not the answer, just making a point. So the partnership is the second form of business, and we're going to look at the accounting issues surrounding partnerships in terms of how do we form partnerships, how do we dissolve them, like get rid of them, and how do we liquidate them. And you'll find out what all these fancy words mean in a little while. Okay? Of course, whenever there's a partnership, they make money. So that means they have to agree on how they're going to share the income. And of course, if there are any losses in the partnership, they have to come to an agreement on how they're going to share those losses. Okay. Does your textbook have a decision point? Anyone? Does your textbook have a decision point at the beginning?
What's that?
That's just the topic.
Oh yeah. Users focus, holder, and Williams partnership.
Yes, indeed. All right, great. So we're on the same page still. All right. So I keep picking on Natasha first because she's on the top of the list. Okay, Natasha, since you're on top of the list, we'll start with you again. But I promise you, I'll get your colleagues involved. Okay. All
Okay.
right. Can you read that decision list, that little paragraph there for us?
Decision list.
Sorry, decision point. It's right at the beginning of the chapter. You don't have that in your text, huh?
You mean under concepts, underlying partnerships?
Concepts underlying partnerships.
Mm-hmm.
You don't see something that says a users focus, Holden and Williams partnership?
No.
It should be the page right after the title page of the chapter.
Yeah, check the title out right after the title page. After the first page, the second page.
Okay, that starts off concepts underlying partnership, and the sentence starts the Uniform Partnership Act.
Doggone it. So if you go a little
Different
crazy,
book.
you don't. Yeah, I know. I was just hoping that they'd have this in that book. That book doesn't have a decision point?
I don't remember seeing that.
What a shame. Okay. Jerry has that particular edition. So Jerry, why don't you read that decision point so that we can jumpstart?
Jack Holder and Dan Williams reached an agreement in 2010 to pool their resources and form a partnership to manufacture and sell university t-shirts. To form the partnership, Jack contributed $100,000 and Dan contributed $150,000. As they were preparing their partnership agreement, they had to make a number of important decisions. including how they would share the income or losses of the business and how they would handle both the admission of new partners and the withdrawal of partners. In this chapter, we discuss these issues as well as several other accounting issues that partnerships entail.
All right, thank you very much. So now we see the
Mr. Wilkinson, sorry,
yes.
that was actually on my title page.
Oh,
Yeah. Yeah,
doggone it.
it's different.
Well,
And
I'll tell you.
the names are different.
Yeah, I know, but it's the same. Blah blah blah.
Yeah.
Yeah.
Good.
In the old days, we had an expression for when that happens to us. We say we can't see for looking. Ever heard that?
Yes.
That's a case of can't see for looking. happens, happens to all of us, by the way. All right. So now we have our introduction to the partnership. We know now that it's much more than just the second type of business form. Once you decide to get into a partnership with somebody, you better know who you're getting into partnership with. By the time you're done this chapter on Saturday, you'll think very carefully about partnerships. Not that anything's wrong with them. Partnerships can work very well. But if you end up with the wrong partner, you'll discover that it can cause a lot of pain and suffering. All right. It's just like a marriage. We remember we say marriage is like a partnership because indeed it is. Some people come into business partnerships with nothing except maybe expertise, no money, no assets. Some people come into marriage with nothing, just promises. Like, I promise I'll be something. I don't have anything. I know you have stuff, but I promise I'll be something, or I'll be a slave, or I'll bring whatever we promise to bring to the partnership. That would be their contribution. But usually in business, we don't take that kind of promise. Whenever we start a business partnership, we expect that that business partner will bring something, either money, assets, or both. If they can't bring cash, assets, or both, oftentimes, if not all the time, the other partner will not accept that person because that's a risk. Okay. In business, do not bring in a partner who is not bringing anything unless they can satisfy you that they will eventually get something in the shortest possible order. And even then, there's still risk. Okay. So the question is, when we're going into a partnership, first of all, do we need a partnership agreement? If we do need one, what will go into that agreement? How do we share income at the end of each year? How do we share losses? And if we want to bring in a new partner, how do we do that? If we want to get out of the partnership, how do we do that? Getting out of a partnership is kind of like getting a divorce. I don't know which is worse. Both of them can be contentious, but perhaps getting out of a business partnership is a little bit easier than getting out of a divorce, depending on what's going on. All right, so welcome to partnerships. And let's see. Partnership has been defined actually in the text as, quote, an association of two or more persons to carry on as co-owners of a business for profit. Okay? Because you know, some businesses are what we call not-for-profit, like charities. A partnership is for profit, and it consists of two persons or more who come together to go into business to make a profit, which means that if it remains unprofitable for a certain period of time, maybe the partnership agreement should have a clause in there saying that if after 3 to 5 years the partnership is unprofitable, we'll decide to shut it down. Okay. All right. Partnerships are also separate entities, we are told, separate from the legal corporation. However, there are some acute differences between the corporation and the partnership that we'll see in a little bit. The partnership in some respects are separate from its owners like a corporation, but not entirely. And we'll see very shortly how that separation works. Okay? So what are some of the characteristics of a typical partnership? Well, first of all, it would not make sense to go into a partnership without a partnership agreement, which a lot of people do, by the way, for some reason. And then when things go wrong, there's a big fight, there's a big argument about who should get what, and there's no agreement. Okay? The law has come up with a solution for those partnerships are foolish enough to go into partnerships without a partnership agreement. What the law says, if there's no agreement, then everything will be shared 50-50. Simple as that. Solves the problem quickly. Okay. Please note that a partnership agreement does not have to be in writing, but if you're smart, you will make sure it's in writing. Because people forget what they say. Sometimes they really forget, and sometimes they forget on purpose. But whatever goes in writing, you have to worry about who forgot what, who said what, when, and where. It's there, and everybody's signature is there as well. It's a good practice to put into partnership agreements, just in case something goes contrary. The agreement should have a whole lot of stuff in it, including who the partners are, where the partnership is located, what is the purpose of the business. All of these things should be in the agreement. The name of the partners, their duties, what they'll be doing, what they'll be investing, and so on. How will income and losses be distributed between them? All of this stuff should be in a partnership, which explains why a lot of people don't get into it, because a lot of persons, especially if they're forming small business, they don't want to get into the cost and time it takes to write a partnership agreement until things start to go to hell, and then they start crying, like, I should have done an agreement. By that time, it's too late. Okay. The agreement should always also have distribution of income and losses, how it's going to be done, and what the partnership will do if somebody wants to come in, if somebody wants to leave. All this stuff needs to be in the partnership agreement. Okay. Of course, this is a typical question. List and describe the key characteristics of a partnership. Yeah, I'm very likely to ask that because all of these characteristics are important. What about limited life? Anybody read that? What do we mean by limited life of a partnership? What does that mean?
A partnership, like probably unlike another business, like a corporation, can't last forever because, and I'm assuming, every time a partner like leaves or dies or we add a new partner, the partnership has to start over.
Absolutely, absolutely. So when somebody dies or leaves or some such thing, the existing partnership is dissolved and a new partnership agreement has to be formed. Okay, so the life of a partnership, unlike a corporation, is limited. In the case similar to sole proprietorship, when the owner dies in a sole proprietorship, that's it. Everything dies with him or her. With the partnership, if somebody resigns, leaves, or dies, the partnership dies as well, and a new partnership agreement has to be established if it is decided to continue with the partnership. Okay? Absolutely. And of course, if you want to continue legally, then the best route to go would be to prepare a new agreement. That will solve a whole lot of problems as usual. All right. And of course, again, the conditions of dissolving the partnership, it's always a good idea to put those conditions in the agreement as well. For example, if a partnership dies, resigns, or otherwise withdraws, then we agree together as a partnership that the existing partnership will be dissolved and a new partnership agreement established among the new and continuing partners. Okay. All right. So that's the second characteristic. Partnership agreement is the first, limited life is the second. Then we have this strange characteristic, number 3, called mutual agency. How does your text define mutual agency? What does it say about that? Mutual agency.
It basically says any partner can bind a partnership to a business agreement as long as he or she acts within the scope of the company's normal operation.
Absolutely. So just like a marriage, if, for example, one of the partners in the marriage, the husband or the wife, goes out and make a decision to finance something, or a decision that puts unnecessary strain on the finances of the household, then for all intents and purposes, the other spouse is stuck either directly or indirectly as a result of that decision. Which is why if you marry the wrong person or bring in the wrong partner and they make such a decision, they can put the partnership and the marriage in jeopardy financially and sometimes otherwise. Okay? And that particular behavior is called mutual agency. Now, there is a caveat. We are told that under mutual agency, a partner may go out and commit the other partners in the partnership to whatever decision they make, but that partner's decision has to be commercially and otherwise related to the partnership itself. If the partner makes a decision that affects him individual or his personal family, that does not affect the partnership. That partner would have to do something or contract in such a way that it connects to the partnership or is related to the partnership itself. Otherwise, mutual agency will not apply. Okay? But many partners in the past and present have gone out and made agreements that got the partnership tied up in stuff that they didn't agree on as a group. And some of those people in those kinds of partnerships have a tendency to do that. It's called being brazen. The old people called it, and then come back and tell the rest, and they're like, why didn't you tell us? We didn't discuss this. And like, well, I thought it was a good decision, so what? And so they take the attitude, what are you going to do? Kick me out of the partnership? Especially if they're a partner that has been doing some successful things in the past. As they start being successful in the partnership, sometimes they start taking liberties, like carrying on with mutual agency problems, committing the partnership to stuff that they shouldn't, or certainly without discussion. All right, number 4, unlimited liability. I wonder what that means. What does unlimited liability mean? Okay, I'm going to, Andrika, what does that mean? See if Andrika is there.
Unlimited liability. I guess it means, or how do I put this?
Say it again.
I guess if the company is in debt, or if other partners are in debt, you are also in debt. And
Okay.
it doesn't,
Go ahead.
and it doesn't stop, like it's continuous for as long as your creditors, like anything, your personal assets can also be seized
Yes.
to satisfy your creditors.
Yeah, within the partnership, yes. So if the partnership has some debt, and for some reason the partnership is not able to pay that debt, and the creditors come after the partnership, and the partnership itself does not have the money to pay, then the creditors can then start making claims against each partner's personal assets. So they can take your house, the car, the dog, your spouse, your children, everybody, until the debt is satisfied. Each partner, right? And so that is a major drawback for partnerships, but we still have many, many partnerships around the world, so it doesn't stop people from getting into partnerships. They just have things in place to try to make sure that the partnership is successful and they keep debt to a manageable level, such that the partnership itself can cover its own debt. Certainly, some partners in the past have lost their shirt because of unlimited liability, but for the most part, partnerships seek to be able to cover its liabilities from its own day-to-day operations. But it is something to keep in mind for partnerships. The other characteristic has to do with co-ownership of partnership property. When individuals invest property in the partnership, it becomes the property of the partnership. You don't own it anymore individually. Sorry. If you wanted to keep it for yourself, don't join a partnership. Jerry, if you had property before you got married, your wife is going to stress you to put it in what names?
Who name?
And what names? Her name or both?
Name, my name. If I had it before.
I know, but she's going to try and tell you, now that we're married, Jerry, now that we're married, here's what you need to do with the property. We need co-ownership. What does she mean?
I see. She would like what's the word? What's the accounting term?
Or the legal term.
What's the legal term for that?
Well, if you bought the property before you got married, like when you were a bachelor, before you even met and got started dating and got married, you bought the property because you want to make an investment, and then one day you want to get married, yes, and have a family and build a house and all that stuff. All right, so the property's in your name because you bought it when you were single. Uh, but now that you're married, then she's gonna say, well, um, you may as well put it in of our names because we are now a what? Partnership. And that is one of the characteristics of a partnership, Jerry. I did that course before. What do you do?
Oh, me? What do I do?
Well, not you, but what should what I know. I'm just putting it to you in a contentious way to show you that you have some really strong decisions to make going forward, correct?
Well, in the terms of a partnership, I would like to keep my liability as limited as possible.
She will not let you. She's every day she's gonna say, if you love me, Jerry, you put it in both of our names. How come if you didn't want to do things together, you should not have married me? You bastard, I should have listened to my mom.
Guess what? But
What?
some people don't have full disclosure. They said this little piece of property I had before I was married, and I keep this as undisclosed.
Yeah, that's true.
And start over together. What we do from here on out? Joint.
Yeah, which is really how it should be. Anything in your name individually uh, should remain individual unless you choose to make it joint. Okay. The reason why some people don't disclose because they know that their partner, male or female, is going to harass them to make it joint. Okay. Now, guys are quicker to do joint stuff than chicks. Chicks are not real quick to do joint stuff. Okay. But guys, for some reason, we like quicker to do joint stuff because we want to please our bride and all that. The old school thing. All right. But that's what just educating you guys a little bit. That's
So,
what
Mr. Wilkinson,
yes.
so what about, I don't know if you heard about the case the other day. This marriage obviously ended in divorce. And the husband in the beginning initially put his assets in his company's name.
That's
That's a lot.
Yeah, but the
What's the name of
judge
that
still
story?
ruled in the wife's favor,
yeah.
and he has to split everything with the wife, even though he put his assets in his company's name.
Yeah. Well, first of all, um, by the way, that's something that guys used to do back in the day so they don't lose everything. Because what happens basically is this typically if a man has assets,
Hmm.
gets married, it doesn't matter if his wife didn't come into the marriage with any assets. The typically the marriage thing creates something of an automatic, not always,
Okay.
depending on the what's in his name before he went in and what's in his name after he went in and so on. Now, if he may have put those assets in a company after he got married, and therefore the judgment made that decision because they say he's quote unquote hiding his assets, so she doesn't get quote unquote her share. And when in a marriage, it's like a partnership. Once it goes into one pot, it doesn't matter if your spouse is a bum, lazy, or doesn't contribute anything. They could lay off all day and have fun. But once and the divorce comes through, courts will still rule a minimum 50-50, or if you can prove otherwise, maybe a little differently. If she has children, doesn't dog eat your lunch, Jerry? Because the court is going to rule, first of all, that she gets the children, and then the children needs everything they need. So you'll be like left with very little, and she and the children will run off with everything, and then she'll remarry and keep everything you had to leave with her, and then she has stuff from her new husband, and you don't have anything, and then you remarry. The new wife is looking to you for something you don't have anymore because it's gone.
Wow.
So that is an unfortunate situation, and maybe since men and women are now equal in the world, they say maybe we'll change that to be a little more fair to men going forward. I understand why it was done because in the old days, remember, women stayed home, and so if the husband left the home or whatever, that was done in order to protect her and the children because she was not a bread earner. Nowadays, she earns her own income and she is an independent woman, even though she's married to you. So maybe the laws will change soon to make it a little more equitable so that women
Yeah.
don't be having the cake and eating it too, which would be unfair. Okay? All right. And I suspect if we don't do that, less and less men are going to get married, and then less marriages, less families, less it gets a little stinky. All right. So yeah, that co-ownership, yeah, created all kinds of discussion. But if I didn't tell you before, you'll discover that accounting is not just debits and credits. It's about real life issues like that one. Okay. So that's a characteristic. And then the final characteristic is the participation in income and losses. We said, each partner has a right to share in any income, of course, and any losses. And I keep picking on Jerry because he's a newlywed. Does your wife work, Jerry?
Yes, she does.
Okay, great. So now she can help you with the bills. You don't have to pay all, right?
All in quotation.
I know.
You're a good man, Jerry.
Not all,
Jerry,
but most.
Jerry, how old are you again?
28.
28. Well, the Bible says something that my people perish because of the what?
Lack of knowledge.
Okay, Jerry. I'm not telling you what I'm telling you so that you don't be a great husband. I'm just telling you because you're still young and you may not be fully informed, which hurts everybody. Here's how it should work, Jerry. If your wife was a housewife, then you should pay all the.
Bills. But if
Bills?
she's not a housewife, then what?
If your wife was a housewife, then Jerry, you'd be required to pay the bills, correct?
Correct.
Correct. If she is not a housewife and she's earning her own income and she's her own woman, even though she's your wife, you can't tell her what to do because that's not your job. You don't own her, do you?
Um, why not? Why you can't say that? That's papers, Mr. Wilkinson.
I
Very
know, but
interesting.
unfortunately, Jerry, that was the old days.
Mm.
You are now living in modern times where that does not apply anymore, unless, of course, you are married to an old school girl. And there aren't too many of them left anymore, especially in your age bracket.
I
So,
feel like I got an old school one.
yeah, okay, then thank God you're a little bit ahead of the game. However,
Mm.
however, uh, if she works, she should contribute to the bills the same as you. That is the correct and fair thing to do. And the bill should be paid in accordance with the level of income each person makes. So if she makes more than you, she should pay a little bit more of the bills than you. If you make more than her, you should pay a little bit of the bills more than her in conjunction with your income. And if you do that, then everybody will be contributing to the household and there'll be no fighting.
I agree. But in most households, you find that the men tend to make more in any case. So,
Not anymore. Those days are going away quickly.
you
And
think
any
so?
man who says he's making more, that's because she lied. She's probably making more. Just tell them she's making less. So it's okay.
Mr. Wilkinson, stop while you're here, please.
And just uh,
He's just keeping it real.
so that Jerry doesn't find out one day, becomes disillusioned and lick in her head with a conch shell, which she's not supposed to do.
Mm.
You can't help them at all. But the truth of the matter is, if both parties are working, they should share the bills in accordance with set income. Your wife is making 5,000, you're making three. It's ridiculous that you should be paying the majority or the most. Makes no sense and it's unfair. All right,
Agreed.
it's not a gender issue. It's just a common sense thing. Okay,
Uh,
don't get away from all that macho nonsense. That makes no sense.
but you tend to see, Mr. Wilkinson, women who make more money don't really get with men who make less money than them.
That's okay. Don't worry about the semantics. See, that's all that is designed to get you tied up. If whatever it is, if you set that as the premise, that'll help you decide whether you stay married or not. If she doesn't want to do it, then you have a problem. If you
Only be
make
aware that there's a problem.
well, of course. The only problem in marriages is sooner or later things come to the forefront. Sooner or later, you can't hide everything forever.
So you talk about these things beforehand, before you get married.
Doesn't Yeah, that's what you're supposed to talk about when you're dating. Usually during dating, everybody's faking and rubbing and kissing up and hugging up and all that. We don't have any discussions about important stuff until after we get married. Then it's too late.
You have to discuss that first.
Yeah, we should, but typically we don't. We're just too busy trying to impress the person we want to marry. Everybody's all snuggly, all mushy, infatuated.
It's amazing how easily impressed, because these are the things that should be impressing.
Exactly. In fact, that is the real reason why people should date. Except that we don't do those things. We get caught up on emotional.
Yeah, Bahamians aren't good at dating. No, they're
Not
not
only
good at
Bah-
dating at all.
not only Bahamians, people in general.
I only deal with Bahamians, so I wouldn't know the others.
I yeah, that's true. And unfortunately, after they get married, then things start coming out and get stinky. And then you fight for the rest of the marriage, or somebody decides that's it. I'm leaving this broke something man or this lying woman.
Date.
Yeah. Okay.
Yeah, date.
Doggone it. All right. So how do we get to that? Oh, participation. I told you accounting is everywhere.
Accounting.
Accounting gets into your life.
Participation of income and losses.
Okay. So if you're in a partnership, whatever income you should share, whatever losses you should share. Okay. That's just how it should be. And in the case of a business partnership, this should be written into the partnership in advance. See, not after the fact. Because after the fact, without an agreement, people start getting stinky. We have an agreement. I don't have to do it. I don't have to do it. Johnny, I have no need to do it. Not just saying people start arguing, fighting, and then the partnership becomes messy and it's dissolved and then has to go to court in order to split the assets for the courts to make a decision and so on. Okay? But of course, we're talking about the way things ought to be, not all the messy things that happen when people don't follow the rules. Okay? I heard somebody blaming the prime minister for the pandemic as if he has anything to do with it at all. Uh, the pandemic is all over the world, and the reason is the same. People are disobedient, won't follow the rules. They are doing all kinds of unsavory stuff and not listening to what the rules are. They are the ones in mass who are creating the problem. The prime minister, like no other leader around the world, they cannot control all these people. They can't be where they're going to be 24/7. And so everybody is suffering as a result, kind of like a big old stinky partnership where the innocent is suffering for the guilty, just like in a business partnership, just like in a personal marriage. Whenever something goes awry and somebody doesn't follow the rules, everybody suffers in the partnership. So now we have this big old countrywide partnership where we're all in it together, and those who are listening are affected by those who are not. It's really quite that simple, has nothing to do with Dr. Minnis or anyone else. All he's doing is trying his best to do some things to see if he could get people to listen. He's not a magician, nor is he God. And certainly, if disobedient Jews piss God off in the Bible, imagine, and he was God. Minnis is a mere mortal trying to figure out how to deal with people who won't listen.
That's true.
Only so much that he can do, and he's done all of that and then some. Okay?
Mere mortal.
I guess he was just unlucky to have to make these decisions because it shows that.
Well, he's not. Well, Jerry, he's not unlucky. Every leader in the world has to make it. He's
That's what
not.
I mean. But compared to the other leaders we've had in the past, they didn't have to perform under these circumstances. So
All the more reason why people should follow the rules and understand it. But they're talking like they don't understand it, nor are they following the rules. That's my point.
I
Okay.
believe in following rules now, but I also believe the rules should make sense.
Well, what part of the rules don't make sense at the moment?
No, I'm not saying they don't. I'm just saying people tend to not want to follow rules when they feel like the rule is made arbitrarily. I'm not speaking on my behalf. I'm speaking from the general Bahamian perspective.
I know.
Yeah.
But what would be arbitrary about the current rules?
For instance, okay, 1 hour earlier for curfew. That's a very, to me, that's a very inane um, measure to take. Cause I don't feel it does personally.
Okay, so what should it be?
I believe that the main, well, see, that's where beliefs and research come into play because some persons may feel like it isn't the Bahamian people that are actually causing this outbreak. Some people believe it's the tourists. So,
But
like
how
I said,
do
I'm not speaking for my yeah, I'm speaking this in
I
general.
I know. I know you're not speaking from your perspective. Thank God you're not.
but
Because see, viruses is like a venereal disease, right? Isn't it?
it's
It's hard to say where it came from.
it's very hard to say that.
So, and so therefore, if you want to protect yourself against a venereal disease because you don't know where it's coming from, what do?
We take measures in order to prevent spread.
You wear a contraceptive, wouldn't you?
Yes, yes.
Yeah. So all this stuff we're trying to do is just a contraceptive to see if we can beat this virus. But if people keep going out and having illicit sex without being protected, not following the rules, then we're back to square one again. We were doing well, Jerry.
I know we were doing well. I know.
Yeah. But again, I saw people all over the place partying without masks, having a ball, beaches, bars, restaurants, having a ball. Say, man, they hate that life of being restricted. Well, if you hate that life of being restricted, then there are consequences. The only problem is the innocent also suffers further.
Well, to continue with your analogy, if you tell someone oh, they can't have sex after 11, they'll just have it before 11. That's
But
always
no,
going to happen. You know,
well, yeah, yeah. So, what would be your recommendation if you were the leader?
just if you really want to prevent that, then you just say no sex at all. You
Oh,
know,
no,
You can,
I mean, yeah, abstinence is the best
no,
contraceptive I
of
hear.
course,
that's the best.
no, of course, that's the best way. That's the point. So, what would be the recommendation for the
That
coronavirus?
lockdown, but I know the consequences of that are also apparent. So it's like,
Can't
what do
have
you
our
do?
cake and eat it too,
Yes, what
can
do you
we?
do?
We,
No,
well, we survived lockdown for almost a year and didn't kill us, did it?
no, it didn't.
Okay.
I
So all we
enjoyed I
Starve
enjoyed
some
it
people
actually.
though.
Well,
It
yeah,
starved some people.
so all we need to do is stop gathering, stop getting into these groups, stop fanning around with people all over the place, and just keep following the rules until the thing tapers off somewhere in the future. But we're not that gracious, are we?
For the most part, people aren't going to do that with certain
And so
age,
therefore,
gender. They just want to party, free
as
for all.
the same thing has
Well, they did
happened.
say the ones with the vaccination party on and carry on, so they have been carrying on.
People with
Out of its
vaccination,
mouth,
people with
not a
vaccination,
wise statement.
no, not at all. But at the end of the day, my Grammy had a simple statement, and I'll tell you what she said. If you can't hear,
You'll feel.
simple, whatever. We don't, and as always, the innocent will always suffer with the guilty. Remember, whenever war breaks out, the guys who are fighting the wars are not the only ones who suffer, are they? Are they? No, everybody suffers. So the best way to prevent suffering is to try and prevent a war. But once war breaks out, all of us are finished in it, suffering, blown up, no food, building, everything. It's a mess. That's how it is. So we have to decide what side of the fence we're going to be on. And in this big old partnership in the Bahamas and around the world, if we don't hear, like my Grammy says, we'll feel as we've been doing all along. It's
Yeah,
grief. It's
Bible.
that simple. Absolutely. And
Keep
all of us
personal.
and all of us have to hear individually. We could come up with any excuse to hang out and do whatever crazy stuff we're doing. That's fine if you choose that. Just know there are always consequences, no matter what excuse you give. That's the point. All right. So, so those are the characters. Accounting gets into your grits all the time. those are the characteristics of the partnership. Another popular test question are the advantages and disadvantages. So you want to know them. One of the advantages, there are a couple of them. Partnerships are easy to form, easy to change and dissolve. Somebody leaves a dice, dissolve the partnership, start a new one. Partnerships allow us to take all of our resources and pool it into one, which gives us more resources as opposed to us individual persons. So you can put in cash and assets and talents and all this stuff. There are no taxes for partnerships, so they don't have to pay any taxes. Partnerships are not legal entities like corporations, so therefore they do not incur corporate taxes, which is a big plus. Okay. So these are some of the important advantages. There are some disadvantages. Does anybody see any of the disadvantages? One?
Life of a partnership is limited.
Yeah, we know that from the characteristics, meaning when somebody leaves, dies, or withdraws, retires, then the partnership dissolves. Any other disadvantages?
One partner can bind the other to a partnership.
Yeah, what do we call that?
Mutual agency.
Exactly. So I say week after next, what is mutual agency? Don't say, did we do that?
Yes, one partner binding the other.
Absolutely. Any other disadvantages?
Unlimited personal liability.
Which means?
Both personally liability of any shortcomings of a business, any debt.
Which means? You're right so far, which means?
Means one have to give both are in debt. If there's any debts,
I
both
know,
have to pay.
I know what you're trying to say, and you're on the right track. What it means is if the partnership has debts to pay and the partnership cannot pay it, then the creditors can come after the personal assets of each individual partner. Okay?
Okay.
That's what that means. So if you go into partnership with your best friend and they outsmart you by putting the partnership in debt and the partnership can't pay, then the bank is going to call you and take your car. And if that doesn't cover it, they're going to make a foreclose against your house. And if that doesn't cover it, then they'll see if you have any money in the bank. See my point? Did I make that sound like ominous?
Sorry, I didn't hear the last part. I was distracted.
Please be aware of unlimited personal liability if you decide to go into any partnership. If it fails, the creditors will come after your personal assets, whether you like it or not.
Okay, noted.
A lot of people have discovered that afterwards because they don't discuss it like when you're dating until after the partnership. They're so excited about their new business venture. See? They don't talk to discuss important things like that until it's too late. Many persons have lost personal assets as a result of that particular disadvantage within a partnership. That's why I often told, if you're going into a partnership, beware. I'm not saying don't go, just make sure you have all the ground covered. Otherwise, you will become a victim. And what's the last disadvantage? What's the last disadvantage?
It's more difficult for a partnership to raise large amount of capital.
Indeed. Okay, corporations can raise money to the stock market, partnerships cannot. If a partnership wants more money, it has to get another partner or two or three, or go to the bank to borrow them. Okay, so it's a bit more difficult to do that.
So 1 minute, Mr. Wilkinson. With an aspect in reference to the unlimited liability, so you would think that would be good for both partners to have monies held in escrow for any further expenses?
You mean within the partnership?
Right.
Yeah, they should
Just
do
have
that.
a holding account,
Yeah,
just in case, to cover each other back.
Always. The only problem is in the real that's great on paper, and that's what we should do sometimes if we could. The only problem is when you get into business, sometimes you don't have the money to put in reserves because the business keeps demanding things. Okay?
They
But if-
normally say a business don't make money until probably after the first 5 years. So
You get there.
if you get there.
Yeah, so oftentimes there isn't any money to put in quote unquote reserve. But if you do have an opportunity because your product takes off and unexpected sales and you have extra money, of course you want to put in reserve. The only problem is if your debts get so great that it eats up even your reserves, then the creditors can still come after your personal assets. But the reserves will keep them from getting to you sooner individually. Okay, that's the key. All right. We also have this other group, two groups that we refer to as limited partners and joint ventures. These are typical associations that are different from the partnership that we were talking about. They are a type of partnership, but they're a little different from the ones we were talking about previously. Okay. The
Mr.
limited-
Wilkinson,
Mhm.
I have a question. So
Yeah.
a company like Tops, would they be considered unlimited liability?
Tops lumber,
Yeah, the place that closed down this year.
that wouldn't be tops lumber, would it?
Is that Tops? What's the place that closed this year?
On Shirley Street?
On Shirley Street.
Ah, yeah, I know that's been there for a million years from I was a boy and before.
Mm-hmm.
God knows what happened there. In order to find out what type of business that is, because see, that probably may have been started out as a family business.
Okay.
It may have still been a family business when it went down, because it may be generations of family just brought it to its knees. You follow? Or
Okay.
other poor business decisions. To find out what type of business entity it is, first of all, you'd have to take the name of the company and go to the registry to see if they are incorporated.
Okay.
All right. If they are incorporated as a company at the registry of records, then they are a company, corporation.
Okay.
Follow? If they are not a corporation, then further investigation might reveal that it was a partnership, a family business.
Okay.
Okay. So it all depends on what the paperwork actually says, if you can find out or get your hands on that.
Okay.
But it would be one of the three.
Okay.
Okay, absolutely, absolutely. So the limited partnership is described as a special type of partnership, meaning that in some ways it's like a corporation. Okay, and because it's like a corporation, because it has what we call the potential to lose its overall investment, and as a result of that, you are only liable as a partner to the amount of money that you've invested in the partnership. Remember the previous partnership we talked about, if the partnership goes under, they come after your personal assets. For a limited partnership, it's like a corporation. If the limited partnership fails, the creditors cannot come after your personal assets. Does everybody get that difference?
Yes.
Okay, very important difference. So when you see LLC, liability company or partnership, it means LLP, limited liability partnership, it means it's similar to a corporation in that liability is limited, that creditors cannot come after your personal assets. So that would be a safer type of partnership to get into if possible. Okay? The only difference is, though, that the limited partner has certain special characteristics that does not normally occur in other partnerships that we talked about earlier. The limited partnership has this feature called a general partner. And the general partner is like this person who is probably the main person in the partnership, the major contributor of assets, the major contributor of skills, whatever the case might be. And so this general partner would be the only one in the partnership with unlimited liability. They'll take all the risks, they say. And any other partners coming in, they allow them to come in under limited liability. So that's how the limited partnership works. Okay? Your investment is limited to what you put into the partnership, and only the general partner has unlimited liability. Everybody else is limited. Okay? Very important feature. Joint ventures, on the other hand, a little different. Joint ventures are usually an association of two separate entities that come together. So two separate companies, not a partnership of any kind, two separate entities or companies that come together for a specific purpose. And then when the purpose is over, they go their separate ways. Okay? That's how joint ventures work. Uh, they decide how any bills and liabilities, etc., will be shared, and they have an agreement. And then once the project is done, they agree to go their separate ways. Some partnerships are like that too. They only form for a particular purpose. Like some people, they don't get married because they love the person. They get married because they plan to leave the person and carry stuff. And so I'm just being a devil's advocate, but it does happen.
Mhm.
All right, unfortunately. But joint ventures, they are two separate entities that come together for a specific purpose, and then when they're done, they go their separate ways. Okay? Usually, joint ventures from separate entities come together because they have more resources, more technical skills, political clout if it's a country making a decision, and all this kind of stuff to achieve a common goal. Any profits and losses, they share them and go their separate ways until some other venture comes up, and then they form a new joint venture and go at it again. Okay. All right. So now we have, okay, Natasha, let me come back to you. Um, can you see that focus on business practice, Natasha? Corporations that look like partnerships? Natasha, can you see it? Natasha has gone off for tea. Okay, Andrika, can you see that focus on business practice?
One moment.
The heading is corporations that look like partnerships.
Nope, I do not see it.
You don't have that.
No, I don't think so.
That doggone edition has left off all the good stuff. Okay, Jerry, do again. Corporations that look like partnerships.
Corporations that look like partnerships. Is that what it's supposed to say?
Yeah, can you read that little block right there?
That's not what mine says.
What does yours say?
Okay, no, I see, it's a separate
Okay,
one.
and see for looking. That's okay.
Corporations that look like partnerships. Some types of corporations mimic the characteristics of partnerships. S corporations are corporations that U.S. tax laws treat as partnerships. Unlike normal corporations, S corporations do not pay federal income taxes. They have a limited number of stockholders who report the income or losses on their investments in the business on their personal tax returns. This avoids the problem of double taxation. In a limited liability corporation, LLC, the stockholders are partners and the liability is limited to their investment in the business. LLCs are used mainly by accounting and consultancy firms. Special purpose entities, SPEs, which gain notoriety because of the Enron case, are firms with limited lives that a company creates to achieve a specific objective, such as raising money by selling receivables. By meeting certain conditions, a company that sets up an SPE can legitimately avoid including the debt of the SPE on its balance sheet. Enron uses SPEs extensively and fraudulently to hide debt and other commitments.
Thank you very much. So these LLCs are great if you're using them for legitimate purposes. Unfortunately, in the case of Enron, they use these special purpose vehicles called LLCs to set up loans and other debt that they put the company in the millions and billions of dollars. And because they were set up in a separate limited liability company, these debts were not shown on Enron's balance sheet, so they were hidden, and nobody knew that the company was so seriously in debt until things collapsed completely. And eventually, Enron, which was a multi-billion-dollar company, is no longer in existence. So crime still does not pay. Okay? Because certainly what they were doing was fraudulent. They were intentionally deceiving the government, their shareholders, their employees, their bankers, and everybody else who had faith and in their pension funds. People lost millions and tens of millions of dollars in pension money. People who've been working for 30 and 40 years went down the drain. They didn't get 1 cent back. Some of those people, unfortunately, committed suicide. They just couldn't live with it for some reason. Okay? It is unfortunate that these things happen, and they still do happen. That's why one of the important things about study and information and business practice and anything else we do is the question of ethical behavior. Okay? Doing the right thing, not stealing money, not being fraudulent, not running schemes to fill your pockets along with whoever else might be involved. We're not supposed to be doing those things, but every day somebody's planning a scheme because we are inherently fraudulent, greedy, and wicked, they say. Not all of us, but too many of us. That's the problem. That's why Jerry is a regulator now. He is going to eventually be doing inspections one day of financial institutions to see if they're in any money laundering activity and so on. All because people still refuse all too often to do the right thing because we're greedy and we're always looking to get more and more, and it's never enough. And we don't think we're ever going to get caught anyway. All right, let's take a moment to stop and apply. Does everybody have stop and apply in the text? The first stop and apply. 12E.
You mean where it says apply it?
Yes, yeah, apply it.
Apply it, yes.
Okay, what is the basis of your apply it? Is that the questions on partnership?
Yes.
Okay, so we're on the same page for once. Great. All right. Indicate whether each statement below is a reflection of A, voluntary association, B, a partnership agreement, C, limited life, D, mutual agency, or E, unlimited liability. All right. Number one. Now let me just do it one by one, see if folks gonna get it. Natasha, I'm sorry, at the top, that's the problem. Natasha, number one. What would you say? Which one of which
I
is
think
it?
she says she having a problem with her mic.
Okay. So Mike, Andrika, number one.
Number one says, well,
Which
the
of,
heading is indicate whether each statement that follows is a reflection of voluntary association, a partnership agreement, limited life, mutual agency, or unlimited liability, or separate entity.
okay, so for number one, which one would you say it is?
That's unlimited liability.
Does everybody agree with Andrika?
Yes.
Yes.
Really? Why do you say it's unlimited liability?
Because
Because you're,
unlimited,
Because
you're committed to paying the debts of the partnership or of your personal assets.
now
It's a must that
be careful now. Number one says when a partner is admitted, withdraws, retires, or dies, the partnership must be dissolved. Which of the
we have a different number
Oh,
one.
we have a different
no,
one.
we don't have that. We have a different.
A partner may be required to pay the debts of the partnership out of personal assets. That's what's number one in our book.
Okay, so then yes, you are correct. What is number two in your book?
Number two is a partnership must be dissolved when a partner is admitted, withdrawn, retires, or dies.
Oh, I see. They just turned it around. And the answer to that?
That would be limited life.
Really?
For number
Okay,
two,
that would be limited life. Yes.
for limited life, yes.
Right.
What is your number three?
Any partner can bind the partnership to a business agreement. That's mutual agency.
That is mutual agency. Yes. Number four. Number 4.
A partner does not have to remain a partner if he or she does not want to.
Which one is that?
That will be limited life. You'll have to dissolve the
Not
partnership.
limited life. Remember, a partner does not have to remain a partner if he or she does not want to.
So the partnership will be dissolved, right?
No,
So they'll be dissolving the partnership, right?
not necessarily. Could be,
If he's
but
withdrawing.
well, which of the 5 answers would be the most correct?
You could say a partnership agreement, I guess.
Well, partnership agreement would be some other stuff. When you think that you don't have to remain, what kind of feeling does that tell you that you have the right to what?
Withdraw.
Okay, so which of the 5 suggests that
I
you have
think
that
that's
right?
voluntary association.
Yeah, it is voluntary association.
Oh, where's that? I missed
It
that.
is the first
Okay,
one.
the top one.
Yeah,
Voluntary, okay, association, you're right, yeah.
absolutely. Yeah. Remember, nobody forces you to get married, right? We said, I'll marry you or something.
Society,
So you,
not anymore. It used to.
no, not anymore. That's old days. Not anymore. People get married for all kinds of other stuff now. And at the bottom of the list is
Love.
love. Okay. Okay. Yeah, Jerry's getting smarter by the day. Okay. And then any more? Any more? Number 5? No number 5?
Oh, yes, yes. From an accounting standpoint, the affairs of partnerships are distinct and apart from those of their partners.
Okay, which one is that? Which one is that?
Separate entity.
Separate entity? Is that in your list of answers?
I don't see it. Oh,
Yeah, that's F.
Yeah, that's F. Separate entities. Does everybody see that? F. Now, if you look at 11E, you won't see F.
There's no F in this one.
No. But in terms of the answer to that question, if the partnership is separate from the individual's personal stuff, that is separate entity. Okay? Just for your information. All right. So I think we've immersed ourselves enough now to get into the real accounting side of things. Because so far we've been discussing the all important conceptual side of things. And now we're going to look at the accounting side of things. And the first accounting side of things that we are going to look at is accounting for the partner's equity. Anybody remembers what equity is? What is equity?
Is the owner's
Equity is
capital?
Yeah, it's the owner's capital. In this case, we don't call it owners. What do we call it?
Partnership?
The partner.
Partner's
Capital.
capital.
Partner's capital, okay.
Partner's capital or partner's equity.
Okay.
What do you think partner's capital or equity actually refers to?
Their assets?
Anything
Yeah.
they invest into.
Yeah, the amount that is invested by each partner. Absolutely. Okay. Your equity is whatever you invest in the partnership. Just like when you buy a home, every time you make a payment, that reduces the mortgage balance and your equity increases each time. Okay. So eventually, let's say after 5 years, if your mortgage was $200,000 and you paid 25,000 after 5 years, then you have an equity now of $25,000 in that property and counting. So that equity is really your investment. So partner's equity is the investment of the partner. All right. So
I thought the first 5 years was interest.
Yeah, it is mostly. But I was just trying to, I didn't want to discourage anybody. For the first, depending on how long your mortgage is going to run for. If you have a 15-year mortgage, then for the first 7 years or so, you'll be paying interest only, and then you start paying off the principal. If you have a 25 or 30-year mortgage, you'll be paying interest only maybe for about 12 or 13 years. Then your principal starts to get a little bit more slowly until you get into your 20th year, and then the principal amount to what your balance has to get. So you don't really start really reducing your mortgage balance if it's a 30-year mortgage until somewhere around year 20. Between year 15 and year 20, you start seeing any real significant reductions. For the most part, the first half of any mortgage typically is interest payments. So what the banks and lending institutions do, they collect their profits up front first. And then they start using your loan payments to reduce the mortgage balance. Really cool scheme that benefits only financial institutions. But that's how they get rich and that's how they stay rich. And if we want their stinky mortgage, we have to go with it. How about that? Okay, and they know that. So let's look at the blue chart. Can somebody just look at the blue chart and just see if we get lucky? What are they trying to tell us in this blue chart? What are they comparing?
They're comparing sole
Partnership.
proprietorship to a partnership.
Yeah, they're comparing the capital account of the sole proprietorship versus the capital accounts of the partnership, and they're comparing the withdrawal account of the sole proprietorship and the withdrawal accounts of the partnership. Now, what is the withdrawal account, anyone? Those of you remember anything from accounting one? How does it
Repeat
work?
that.
Sorry?
Repeat that question, please.
What is a withdrawal account? How does that occur? How does that come about in accounting, in the business?
That's when a owner withdraws money, takes money out of the business.
Yes, not only takes money out of the business, but it has to be for personal use. Remember, if he takes money out of the business for the business, that's not a withdrawal.
That's an expense if it's for any other.
But it's for personal use, nothing else other than personal use. Like he wants to go to Waikiki with someone, and he decides, you know what, my salary is not enough. I can't wait to save it up. Since I have my own business, I'll just take $5,000 out and buy 2 tickets, rent the hotel and all that, and go. That kind of withdrawal will reduce whatever investment you've made in the business. That's why withdrawals are strongly discouraged. And any sole proprietorship or partnership that gets a loan from the bank, they will do outright. Do not make any withdrawals for personal use from this company unless we approve it. Because if you keep withdrawing money from the company, soon you won't be able to pay what? Anyone?
The creditors.
Your creditors, and even your other bills for that matter. But most importantly, your creditors, because they're the ones who are going to come after you if you don't pay them. They're the ones who will put you in court if you try to duck them. They're the ones who get a court order to take everything you have until the creditors' balances are paid off. It's quite as simple as that. Okay? So if you want to go on a trip because you feel you deserve it, fine. Take it out your salary, save it. Don't take it out your business. But many people do that. Some people survive it. Others, when you drive past, you see closed for good. One of the reasons is they've taken too much money out of the business to have fun. Because their wives nag them, Jerry, but she wants something dead bad like her friend has. And since you can't sleep, you just go into your business, take it out, just to quiet her down. And then when your mortgage business loan becomes due, you can't pay. When payroll comes, you can't find the money because you've taken it out to quiet your spouse. And then when you tell her the company failed because you did that, she'll tell you you were stupid to do it. You should not have done it. See, like that. So you're down if you do, down if you don't. So what do? You do the right thing. That is,
What's right?
yeah, do the right thing. Simple. Do not withdraw it, no matter what she does. I'm not cooking for you this week, Jerry. You didn't take the money. I'll give me what I want. Tell her, that's fine. I'll just eat soup. Because you know that you do not need to take that money out of the company because you need that to run the company. It's quite as simple as that. I'm going to leave you soon if you don't give it to me. Then I'm sorry, I'd hate to see you go. But if I take it out of the company will fail. And how will I pay the other bills of the household? And so on. So it's all about the right thing, not all the other things, even though we get caught up often in the other things. All right. So what is the capital for Blake? How much did Blake invest in the sole proprietorship? How much did Blake invest?
You have a different name.
Okay, how much did that person invest?
The sole proprietorship,
Yes.
50,000,
And how much did they withdraw?
12.
So that means the 50,000 then has been reduced by 12,000, correct?
Yes.
So what would be the new capital balance for this sole proprietorship?
38,000.
Absolutely. I wonder what he used the 12,000 for. Maybe to go to the ruins of Egypt, perhaps. Okay. The point is, withdrawals are not good. They are just highly discouraged. They should only be done if it's a life and death situation, if the child needs surgery or something. All right. And even then, it might be better to go to the bank and borrow the money and pay it back. Because if your company cannot withstand a large capital withdrawal, it might sink it. All right. Any capital deposits made by the partners? How much did the first partner put into the partnership?
30,000.
The other one?
40,000.
Did they take anything out during the year?
Yes.
Yes, they did. Okay, 5,000 and 6,000 respectively. All right, so now you see in these accounts how we account for capital that goes into the partnership. Now notice on the liabilities and partnership equity side of the balance sheet, which is the right side, we have first of all the total liabilities of how much?
87,000.
Okay, you have no, that's not the total
No,
liability.
sorry, no, my bad. Total liability is 28,000.
Yes, and then we have the partner's equity shown separately for each partner, which total
59,000.
And so the total liabilities and partners' equity on the balance sheet should be
87,000.
absolutely. If your balance sheet is going to balance, what should your assets be on the left-hand side?
87,000.
Absolutely. It's really quite simple. Even though students still get stuck for some reason, it's really quite simple once you understand the accounting equation and the simple structure of those 4 statements I gave you. That's why I gave it to you. To take you out of the textbook, which has all the numbers and other things that confuse students and get them upset. I got rid of all that stuff and just give you the summary steps so that you can see the connection and learn it a little bit easier. Okay. All right. So each partner then will invest cash in other assets, whatever that might be, land, building, cars, whatever it is, according to the agreement. If it's a non-cash asset, meaning it's land, buildings, car, trucks, vehicles, whatever it is, equipment, if it's any of those things, non-cash, we value them at the fair market value, like how much you can sell it for today. And whatever that is determined to be, that is what we put into the balance sheet.
It's gonna come though any minute now. I mean, I'm scared of what I know coming my way in here. I hope it don't be shit on. But I just
Mute.
Hello?
I just sleep on my daddy again.
Hello? Somebody who's
Who's unmuted?
one of my students is unmuted. Okay. Can you guys hear me even though you're muted?
Yes.
Yes, I prefer to be, I prefer to be muted unless speaking.
No, I don't mind. That's fine as long as you can hear me. That's the point. All right. So whatever the assets are, they go to the debit side of the balance sheet, and then the liabilities go to this credit side at the top, and the partner's equity is shown separately, as you've seen on the right-hand side. Now that we know that, let's look at an example. What's the name of the partners given in your textbook 12E? Is it Jerry and Rose?
It's Lori Mind and Rose Padilla.
Oh,
So mine.
nice. Yeah, so they just give a more complicated names. All right. So we have these two partners then. The first one will invest how much? How much will the first partner invest?
$28,000 and
So
$37,000 worth of furniture and displays.
Okay. So the first partner invests 28,000 in cash, 37 in furniture, etc. And the second partner invests how much?
The second partner invested $40,000 in cash and $30,000 worth of equipment.
Absolutely. But second partner also has a little baggage. What's that?
he owes some notes payable on his equipment.
Exactly. Lucky for him, the other partner doesn't mind that he's bringing his personal debt into the partnership. Remember, once you agree to bring the personal debt into the partnership, it's no longer personal debt, correct?
Correct. Correct.
It means now that the partnership is responsible for paying the debt. You follow? Does everybody get that?
Yes.
Yes.
Yeah.
All right. So if you marry somebody and they have like $100,000 worth of debt and you don't find it until afterwards because they didn't tell you, the debt might be in their name. But once they come into that marriage, somehow the other person is going to still be stuck, correct? Correct? Yeah. Happens all the time, by the way, unfortunately, because if persons knew before, they probably wouldn't get married because it would be too much for them to handle, correct? Which is why sometimes people hide and don't say anything until after you get married. Then they say, oh, I forgot to tell you, I have this loan at Commonwealth Bank for $75,000. And the payment, and then they're gonna say, but Jerry, you don't have to pay it, I'll pay it. You just see, don't worry, I'll think of it. Don't like that. And then after a couple of months, she says, Jerry, I only could pay half of it. We have to find a way to pay the other half. Now all of a sudden you're in it. Even though you didn't negotiate the loan, you were nowhere around. And she didn't tell you, or he didn't tell her until after the fact. Some people have walked out of their marriages shortly after because of things like that, and partnerships as well, because of non-disclosure. They don't find out until afterwards something heavy has gone down. And they're like, you know what, you lied to me, and furthermore, I can't hack this. This is not what I signed up for.
Do we have a credit bureau here yet?
Soon.
We need one in place.
No, soon.
They kept talking about it.
But a credit bureau wouldn't stop you from lying about their debt. Unless
But no, we need a certificate. Your credit rating or whatever outstanding credits you have.
That's not a requirement for marriage.
Make it one. If you want to marry you, a person could demand that.
No, they would have to, the person could demand. No, they could demand it. If you don't produce it, then they say, I'm not marrying you.
That's it.
But there's no law.
No, that become your personal request.
Yeah, but some people,
have to be a law.
Some people already have that request.
Okay, that's good then. Good for them. They're smart. Those are the ones with assets, probably.
More than likely. Or they could be without assets and they don't want to take on any.
True. Either way, you don't want to start from the bottom to work your way up.
Well, remember, marriage has been such a great facilitator for so many people in the name of love. And we need to stop that deceitful stuff.
Love, 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 love.
You don't love the person, tell them I'm marrying you for money or security or something. Don't lie and say, I do love you.
Hey, love.
But sooner or later, your lack of love for the person will come out
True.
anyway. And then it starts to get stinky, messy, and in some cases, downright murderous. Okay. Can I say a word to the wise? Okay. So now that we know what the capital contributions are going to be made by each partner, we can then go ahead as the good accountants that we are and make a journal entry. Remember the accounting cycle? Anybody remember that, the accounting cycle? I'm the only one who remembers the accounting cycle.
No.
Remember, the accounting cycle begins with a transaction, and then once you come up with a transaction, which is the investment, then we have to make a journal entry, correct?
Right.
Okay, so now we're making the journal entry. How do we do it? How do we journalize the entry for the first partner?
Like debiting cash,
Yeah, for how much?
28,000.
Okay,
Debiting furniture and displays,
for how much?
37,000.
Okay,
And crediting Lori Mine Capital for 65,000.
why 65?
Because that's their cash and furniture,
Yeah, it's the total investment that.
total, right?
What is the narrative that we make for Laurie's investment?
Initial investment of Lori Mine in the mine on Padilla.
Okie dokie. And then the entry, and again, this is July the 1st day of business. What other entry do we need to make the same day?
A rose.
Yeah, what do we get with Rose? The journal entry should be there.
You debit the cash,
For how much?
40,000.
Okay,
And then you also debit the equipment for 30,000.
uh-huh.
But he made a withdrawal of 10,000. Sorry, she made a withdrawal of 10,000.
Is it a withdrawal?
Well, not a withdrawal of notes payable, sorry.
Yeah, this person came in with debt.
Mm-hmm.
They have a note payable to the bank of,
$10,000.
so that has to be shown as a liability in the journal entry of credit.
Credit of 60,000.
No,
No, sorry,
we credit,
10,000.
yeah, we credit an account called what? Should be there in the journal entry. I'm looking at a journal entry. You guys are not looking at journal entry? There's no account called notes payable in the journal entry?
Yes.
Yes, notes payable for 10,000.
Yeah, we credit an account called notes payable. Remember, in accounting, every payable is a liability, something you owe. So this partner came in with $10,000 that they had personally, brought it into the partnership, so now it's on the partnership books. Note payable, $10,000. And then the other credit goes where?
Into the initial investment of Rose, Padilla, and Mine and Padilla
For how much?
for 60,000.
Now, Rose actually invested 70. How come her capital is only 60?
Because she came in with a liability of 10,000,
Yes, so her capital is reduced
by
because
10,000.
of her debt, yes. Okay? All right, so when you're starting a partnership, those are the two entries you make for the partnership. Of course, they're gonna come up in homework later on and test and all that. Of course, these are fundamental. You can't start any accounting practice without those two journal entries, period. Otherwise, you're not fulfilling your job as an accountant. That's the whole reason why we're doing this. All this other stuff that we're learning is just collateral, extra. Okay? Remember, the assets that are not cash, that are assigned to the partnership, they are based on fair market value. In other words, whatever you can sell it for, that's the amount that you use to record the asset at the beginning. If you came from another partnership or business and your book value is X amount from your other business, that's not what we use for the new partnership. You have to then take that same asset, go into the market and say, how much can I sell this for? Whatever the market says it is, that's what you put into the new partnership books. Doesn't matter what it was before. Simple as that. Don't complicate it. All right. Stop and apply again. Anybody else stop and apply right after those journal entries?
Yeah, apply it. We do.
Okay. What are they showing you in apply? What are you seeing?
It says on June 1st, Daisy and Malcolm form a partnership to operate a fitness center. Daisy contributes cash of $24,000 and Malcolm contributes exercise equipment that costs $20,000, but is valued at $16,000. Prepare the journal entry to record the partner's initial investment.
Okay, so this entry is the same as what we saw before. The only difference is the equipment, according to Tom Jones, was actually 20,000 in his books, but when he went to the partnership and had them appraised, the appraised market value is only 16,000. Absolutely. And that's why we do the fair market appraisal, so we can get the current market value. Because remember, sometimes people have things and they want to sell them for what they think it's worth. What you think is worth has nothing to do with what it's really worth. And the only thing it's really worth is what the market says it's worth. So if you love something and you want to sell it for 20, and somebody says, I'll give you 10, and you go to 10 other people and he says, I'll give you 10 or less, what will you do? Keep it or sell it for the highest 10, correct?
Correct.
Because even though you think it's 20, the market says it's what?
The market says what is
It's
value?
10 or less.
Mm-hmm.
Okay? So if you don't want to take what the market says is worth, keep it. But if you really want to sell it, then you have to sell it at market price. Simple as that. That's how it works. Okay. So that's how we set up the partnership. Having set up the partnership, then we can look at how to distribute income and losses. All right. So Natasha, you back with us now? Not yet. Okay. Frederica read already. Cheryl, why don't you pick it up? Do you see that top? It says a partnership's income and losses under the heading distribution of partnership income. Can you see that, Cheryl? Okay, where did Cheryl go?
Okay, you want me to read this?
Yeah, absolutely. A partnership's income and losses.
A partnership income and losses can be distributed according to whatever method the partners specify in the partnership agreement. If the agreement says nothing about the distribution of income and losses, the partners share them equally. Income in this form of business normally has three components. One, return to the partners for the use of their capital, called interest on partners' capital, compensations for services the partners have rendered, partners' salary, other income for any special contributions individual partners may make to the partnership or for risk they may take. The breakdown of total income into its three components helps clarify how much each partner has contributed to the firm. If all partners contribute equal capital, have similar talents, and spend the same amount of time in the business, then an equal distribution of income and losses would be fair. However, If one partner's work full-time in the firm and another devotes only a quarter of his time, his or her time, then the distribution of income or losses should reflect that difference. Distributing income and losses among partners can be accomplished by using stated ratios or capital balance ratios, or by paying the partners' salaries and interest on their capital and sharing the remaining income according to stated ratios. Salaries and interest here are not salaries expense or interest expense in the ordinary sense of the terms. They do not affect the amount of reported net income. Instead, they refer to ways of determining each partner's share of net income or net loss on the basis of time the partner spends and the money he or she invests in the partnerships.
Okay, that's perfect. All right, so that sets the stage. Now we see the various categories of distribution of income and losses. And so we're going to see how accountants in practice actually account for these distributions. Very important, which is one of the reasons why we have to study partnerships as a separate topic, because the accounting is very unique in some instances as opposed to what we call the normal accounting practices. Most of the activities in terms of transactions are typical accounting transactions, but we do have some differences, and the distribution of income and losses is one of them. Okay, so let us look at the scenario then. In the case of our two partners, we're going to use net income of $140,000 as our mark, as it appears in the partnership agreement. And in this initial distribution process of that income, we say one partner will get 60%. Who gets that? Who gets 60%?
Mine.
Huh?
Mine gets 60%.
And if that person gets
and Padilla gets 40%.
How come Padilla only gets 40%?
That's the stated ratio
Yeah,
from my investment.
Yeah, that's what they agree on. Remember?
Right.
These things are agreed and then put into the agreement, and it's done that way so that you can't come back and say, boy, I didn't say that. Then you start arguing and fighting. That's why you agree in advance and you put it in the partnership agreement, so there's no doubt. So if you run across somebody who wants to start a partnership and they say you don't need an agreement, what should you do? What should you do?
Run.
Run. Suppose they are your cousin.
Run.
Brother.
Run faster.
Sister.
Yeah, nobody. No one. Run.
Your mom.
Nope, definitely run.
Yeah, the closer they are to you in business, the faster you better run.
Absolutely.
Because 9 times out of 10, it does not go well.
It doesn't.
Unfortunately. Right? Some family businesses survive, but only after much blood, sweat, tears, and fighting and death, even. But most of the time, they do not work well, which is why we only have a limited amount of family businesses. Okay? For the same reason. So in this case, they agreed to share the income 60-40. Once you do that, the math becomes simple, right, everybody? How did we get 84,000?
$84,000 is 60% of 140,000.
Okay. So I'm not going to ask you how you got 56. If you don't get it by then you need to go back to grade 6. Sorry. Arithmetic. That's what we used to say. You know any arithmetic? What's arithmetic? Okay. Once you understand the distribution and you know what they are, it's simple arithmetic. Okay. By the way, did I tell you you needed a calculator for this class? Every single class plus your examination? I'm sure I did. For those of you who may have missed it, you need a calculator for every single class and your examinations. Okay. All right. So the distribution of the profit of 140,000 has been made. The journal entry is there. What do we debit for the 140,000?
Income summary.
The income summary. For those of you who remember anything from closing accounts in accounting one, if you don't, go back and check closing accounts. You'll see that when a company makes net income, it credits the net income to an account called income summary. And then when the net income is distributed, it debits the net income to income summary to bring that account to zero. And so that's why we're debiting income summary here for 140,000, because we're distributing it between the two partners, correct? Even if you don't remember the income summary account, just know for the purposes of this partnership chapter that in order to distribute capital, you must debit income summary for the total net income. Until you find the time to go back and see how the income summary account works. Okay. Any question on that? The distribution of the 140,000 so far. Good, because it gets interesting. So that's what we call the stated ratios, in this case 60-40. Now we're going to look at the capital balance ratios. How do we distribute income based on the partner's capital? Okay. Again, the capital balance for the first partner in this example, July 1, we told the one partner it's 65,000, and for the other partner, how much is it?
60,000,
60,000.
which is a total of 125,000.
Correct. That's the first thing we do when we're basing it on beginning capital balances. Now, once we have the total beginning capital balance, then we calculate the ratio. Now, if you missed the ratio class in grade six, then this might be a little of a stretch. But if you didn't miss the ratio class, then you will know that it's simply taking the first partner's amount of 65,000 and dividing it into the total, which means that 65,000 of 125,000 represents 52% of the total. Does everybody see that?
Yes.
Perfect. Similarly, 60,000 of 125,000 represents what percent of the total?
48%.
There you go. So now that we have our ratios, then we can do the math. It becomes very simple after that. So for the first partner, we say 52% of 140,000, 48% of 140,000, and we see how each partner shares. Question? Very simple, actually, once you get it. All right. So that's two distribution methods we've seen so far. First, the stated ratio, 60-40. Then secondly, the beginning capital balance ratio. And now we're going to look at the average capital balances. Now, how do averages work? Well, averages take into account the beginning capital balance beginning minus any withdrawals from the partnership plus any new capital that goes into the partnership. So this method is by far the more difficult of the three, but not difficult once you understand it. Okay? So let's look at the ratios based on average capital balances. In other words, the activity in the capital accounts during the year, not just the beginning. Okay? So, first partner, on July 1, when the partnership started, how much did the first partner contribute? Anyone?
65,000.
Correct. We have the capital of 65,000. And the other partner?
60,000.
60,000. Did any of the two partners contribute any additional capital during the fiscal year?
No.
Look carefully at the journal,
Right.
the T accounts.
Mm, 64, 10,000.
The partner who contributed 60,000, did they put any additional money in during the year?
8,000?
The fiscal year, it was the 8,000.
Another case of currency for looking, even though it's right there.
Yes.
It's crazy how that happens. So yeah, one partner only contributed capital once at the beginning, 65, but the other one contributed capital later in the year in 2011 of 8,000. So the total capital by the second partner is equal to how much?
68,000.
Indeed. Did they make any withdrawals?
Yes, Mandela made a withdrawal of 10,000.
On which day?
That's November 1st,
November 1st?
is it?
Well, which partner are we looking at?
Rose Padella.
Oh, Rose. Okay. Okay, Rose made a withdrawal on November the 1st. Or is that
First.
January the 11th? Doggone it. Yeah, let's say November the 1st, 2010. Any other withdrawals?
Not here, no.
Only one withdrawal?
One withdrawal I see here.
That's interesting. Okay, fine. Then let's, now that we have that information of the transactions that occurred on the capital account during the year, we can then calculate the average capital balances. Okay. So let's start with the first partner. Tell me what you see. Do you see the partner's name in this table?
We see Lori and we see Rose.
Okay, let's look at Laurie first. What's the first date that you see for Laurie?
July 1st, 2014. 2014.
2014?
Mm-hmm.
Okay.
That's what
else?
y'all see, right?
I agree. Is that Drika the only one saying that?
Yeah, no, I see it too.
Okay. You see anything else? Anything else under the date?
And then Rose, the T account for Rose Capital. And the date for that is July 1st, 2014 as well.
Are you still in the T account? I want you to move down from the T account because we already know what transactions went to the T accounts. But I want you to look at the average capital balances table.
Oh, okay.
Yeah.
I see that now.
Yeah. So the first partner on that table is who?
Mine, Rose.
What date do you see for Rose?
July to December.
And the capital balance at that time?
65,000.
Okay, times how many months?
Times 6 months.
So we're saying for 6 months, the capital remained at 65,000. Therefore, for 6 months, it equals a total of how much?
390,000.
Okay, and then for the next 6 months, January to June, what happened?
Capital was decreased to 55,000
For how many months?
for 6 months.
Okay, which equals a total of?
330,000.
Okay, so for the first 6 months and the last 6 months, we have a total dollar value of how much?
720,000.
Divided by 12 months to give us our average monthly amount balance, and that equals?
240,000.
Uh-uh.
No, wait, what's the question? Oh, sorry, 60,000.
60,000. All right, so the average capital balance for the first partner is 60,000. Simple arithmetic, it's not difficult. Now, the only question I have to ask about the first partner's transaction is, why is the balance of capital only 55,000 from May to June?
Is that because of the withdrawal?
It is absolutely because of that.
Okay.
Now you can see why this is one of the methods to allocate income. because the person who withdraw the most should get what? Less income, correct?
Okay.
Because they did something to reduce capital, which affects everybody, which means that they should typically get the lesser amount. Again, that depends on how much they invested. Okay, but that's the reason why it went from 65 to 55. All right, so now we know the average capital balance for the first partner is 60,000. Let's go to partner number two. What do you see?
Partner number two, the date is July through October. And
Uh-huh,
the capital balance is 60,000
uh-huh,
times 4 months,
which equals,
240,000.
okay, and then,
The next date period is November through January. The
uh-huh,
capital balance is 50,000 times 3 months, which equals 150,000.
why is it now 50 instead of 60?
Um,
Because if you go further up, you see a withdrawal somewhere, wouldn't you?
I'm looking.
If you check the T account, you should see a withdrawal of $10,000
Mhm.
for that partner.
Okay, so to clarify, both partners withdraw $10,000 each.
You tell me, is that what you see?
That's what I think I understand from this, yes?
Absolutely.
Okay.
If you see an account says partner withdrawal,
Mm-hmm.
then for each one of them, then each one of them withdrew $10,000.
Okay.
That's why from November to January, the capital is only 50,000.
Okay.
When was the 10,000 withdrawn for partner number two?
November. No, no, actually, McDonald. That would have been January.
Okay, and the period we're looking at is November to January, right?
Yes.
So between November and January, they took 10,000, so the capital went down by 10,000. That's why we have 50,000 times three. Everybody see that?
Mm-hmm.
All right, any other transactions for partner number two?
February to June is 58,000.
So it went down or up?
It went up because he put $8,000 back into the business partnership.
Things work out when you stick with it. You sound like a real pro. All right, I didn't even have to say why. You just said because you put 8,000 back in. That's what you would say. All right. So now we have 58,000 by over how many months?
5 months.
When did 8,000 go in?
1,000 went in February.
So it's during the February to June period, correct?
Correct.
All right. So 58,000 times 5 equals?
290,000.
Absolutely. So the total for partner number two for the 12-month period is equal to?
$56,667. No,
Total
$680,000
divided by?
divided by 12, which gives you $56,667.
Correct, which is the average monthly capital balance. Okay.
Mm-hmm.
And so therefore, the total average capital balance for both partners together equals?
$116,667.
Absolutely. Now remember, back in the day, all of this was done manually. Nowadays, we can do a piece of software to do this automatically or put it in Excel, and every period, every year, you just change the numbers, correct?
Correct.
And it will give you your totals. But we're not doing that for class. In class, you have to actually do it. No shortcuts. You can do the shortcuts later in the real world. Okay? So the average capital balance is 116,667. And so we are 1/3 of the way. The second third of the way is now that we know what the average capital balance dollar amount is, we have to now calculate the average capital balance ratios as we did previously. And the average capital balance ratio is simply, what's the formula?
Average capital balance divided by total average capital.
Absolutely. Those two numbers are familiar to you now, aren't they?
Mm-hmm.
Okay. And what percent do you get when you do that?
51.4.
Okay, and we do the same thing for this partner number 2. What percent do we get?
48.6.
And then we go to the final phase of the distribution and take the ratios as we did before, the 60-40 and the 42-48, and then we apply those ratios to the net income. Does everybody see that?
Mhm.
How much does partner number 1 get?
71,960.
Partner number 2,
68,040.
which account is debited for 140,000?
Mm,
I'm so happy to hear people going. That's it. Which account is debited for 140,000 net income? We did it in the previous journal entry.
I don't want to say the wrong answer.
Say it anyway. Say it scared.
Okay.
The income summary account, yes.
Okay.
Okay? Don't be afraid to say the wrong thing. To hell with it. If it's wrong, we just correct it. And sometimes it's going to be right. Doggone it.
Okay.
Yeah, that's one of the things I always make a little humor about our ladies who live like over the hill. When Friday comes, for example, and they get dressed and put on whatever they want to put on, they don't really care who thinks what about it. Have you noticed that? Like they have like multicolored hair, all kinds of different kind of outfits, and things match or don't match. They don't care. Once they like it, they let it rip. Yeah.
They dressing for them, not for you.
Yeah, they're not checking for whether they're right or wrong, you like it or don't like it. So don't worry about it. If you want to blurt something out, let it rip. If it's not the right thing, so what? The hell with it. Then we find out the right thing. That's it.
No, you stop what thinking, worrying about what people think.
Yeah, we keep worrying about what people think. What people will think will choke you to death and cause you not to reach your maximum potential. Remember, I told you that.
Don't worry about people.
Don't worry about what people think. If you think you can sing, start singing. If they don't like it, too bad. Keep
John.
singing until nobody likes it. And then when nobody likes it, then sing to yourself.
That's it.
Doggone it. Don't let the first group, and start singing. It's like I didn't win American stop thing, and so therefore I won't sing anymore. What nonsense is that?
Mm-hmm.
Okay, you're gonna put your whole thing on the line just because Simon and company said you didn't win? The hell with it. The devil with them. Keep singing, dancing, whatever the hell you're doing.
Mm-hmm.
Yeah, and blurting out accounting answers. Don't like it, too bad. All right. So we have seen so far 3 ways to distribute net income. Anybody remembers the 3? Stated ratios, what's the other one?
Stated ratio, capital balance ratio.
Not just capital. There's a word in front of capital.
Average capital.
That's the third one. The second one is beginning capital balance ratio.
Okay. Okay. I see.
Yeah. A lot of kind people looking in this class tonight. But that's okay. And then the other one was the average capital balance. And now we look at salaries, interest, and stated ratios. Okay. So those are the 3 capital balance ratios that we look at to allocate net income. And so we can now look at salaries, interest, and stated ratios to see how they work. All right. In this example, we have the partners again. They agree to pay each themselves $8,000 and $7,000 respectively. Do you see that?
Mm-hmm.
At the end of each year, 8 and 7 each. And anything that's left will be shared what? After paying the sums of 2007, what is shared will be shared how? It's right there in the narrative and the illustration. Do you see annual salaries? They agreed to an annual salary of 8,000 and 7,000. Do you see that?
Yeah, and then what's left will be shared equally.
Yes. You guys took a little long to get to that second line right there. I was hoping you just read it quickly. It has to be nearby. Yes. Whatever's left will be shared equally. So that's pretty straightforward. All right. So let's see how that distribution works. And remember, whatever homework I give you on Saturday after we're done, it's going to be about these things: how to set up the original investment, how to distribute net income, using the different methods. It's not complicated. And so you just sit down and go through all of them until you're tired. And then when you're tired, you snooze for half an hour and then you get up and you do some more. And then you snooze and then you get up and pick an extra question that I didn't even give you and do that one. Because the more of them you do, the better you become, the more comfortable you become. So when exam time rolls around, it doesn't guarantee you ultimate success, but you never know. But it'll certainly make your life considerably easier. All right. So how do we allocate on a salary basis? Well, what is the total income for distribution in this example again? It should be right there in your chart.
Sorry, what's the question again?
What's the total income for distribution in this example? You guys don't see a chart showing the income of partners on a salary basis?
That's there.
It's there?
Mm-hmm.
Okay, so what's the total income for distribution?
Would that be
Remember, let it rip.
would that be 140,000?
That would be 140,000. Why you sound so doubtful?
You said let it rip.
And this time it's correct. Okay. Total income for distribution is 140,000. Under the distribution of salaries, how much did the first partner get?
70,500.
How much?
70,500.
Okay, that's probably what your text is showing. And how much did the second partner get?
69,500.
That's salary?
That's the income of partners from what I see.
Yeah, that's what the and the loss rate.
That's the salary allocation.
Oh, okay. So we're looking at something else then.
Well,
we're on the next page. Wait. What numbers do you have in your book?
I have 8 and 7.
That's what we have.
That's what we have.
8,000, 7,000.
Okay. All right. So
that's the annual salary say. No, agreed to annual salaries of 8,000.
Yeah.
And 7,000.
Yeah, the total distribution is 140,000 again. The distribution of salaries is agreed for the first partner was how much?
8,000.
And the second partner?
7,000.
So the total amount that will be paid out in salaries will be?
15,000.
All right, so after salaries are paid, how much is left?
125,000.
Out of that 125,000, how much will each partner get?
62,500. No.
Why?
Because it's not, wait, no, they do get, it's split equally.
How do you know?
That's
because they paid themselves first.
It's
but how you
based
know?
on the agreement.
Based on the agreement. That's what I want to hear. Don't pull
Okay.
anything out of your hat like little birdie told me. I think so. None of that stuff. It's based on the agreement that we saw earlier in our reading. That's why you have to read everything. Because if you don't read everything, you might miss something, just like your spouse or your significant other. If you don't read stuff, you'll miss stuff. I'm telling you, I've been married for decades, and even now, every time I show up, my wife's still checking me out. I'm like, sweetie, you're still checking stuff? She's like, so? I'm just making sure. which is a good thing.
Mhm.
It's like in accounting or anything else, if you don't check, you might miss something. Okay? You see, she's checking for what she wants to see what my mood is, what kind of day I had, if there's been any change in my normal program, routine, continence, whatever it is. And it's the same thing in accounting. You have to read everything to make sure you are getting the correct information. Otherwise, you will come up with the wrong information and mess everything up, which might ultimately cost you your job, correct?
Correct.
Yeah. But that doesn't only apply to accounting, that applies to anything you do. If you don't read into the stuff correctly and completely and make sure you understand what you're supposed to do, it could ultimately cost you first the embarrassment and then ultimately your JOB. All right, so the agreement is after salaries are paid, the balance is shared 50-50, each one gets 62.5, and so the full 125,000 is used up and distributed fully to the partners. All right, so that's the first example. Now we have a slightly different situation. If you go down a little further, the distribution of salary is still the same, right? Right?
Mhm.
But there's another provision in this second example. What's that?
Distribution of interest,
Meaning?
I guess. That's part of, that would be part of the interest income.
Well, how are we told to calculate the interest? It's right in the reading, right on top of the chart.
It says 10% of the interest on the beginning capital balances.
Okay, okay. Once you read stuff, life is heavenly. When you don't, your life is hell. I can't put it any other way. Read, read, read. And make sure you read carefully, because if you miss it, dog eat your lunch. All right. So in this agreement, the distribution of salaries are the same, 8 and 7. However, there's a new provision in this agreement where they agree to pay 10% interest on their beginning capital balances. So what is the beginning capital balance for the first partner?
65,000.
Which we saw at the beginning, didn't we, in our T accounts, correct?
Right.
That's
Right.
that's the thing about accounting. It all adds up. Don't forget you did earlier because everything is connected. Okay, folks, everything is connected. Because if you don't keep the connections, where did 65,000 came from? All right, so for the first partner, 65,000 times 10% equals?
6,500.
And what's the beginning capital balance for the next partner?
60,000.
10% of that?
6,000.
6,000.
6.
So after we pay salaries, we have a balance of 125,000. After we pay the 10% interest, we have a balance of how much?
112,500.
And then what do we do with the rest of that?
Distributed. Okay, should be equally distributed
How do you know?
as income.
That's what they agreed upon
That was agreed to.
When?
in the beginning of the partnership.
But yeah, but this is a different scenario. Did they state that again for this scenario?
Yes.
Where?
They said
What did it say?
they're assuming income of the remaining income shared equally.
Okie dokie. In other words, don't assume anything. Even though they said it earlier, it may not apply to this one. You just have to read the information they give you for this one to see if it's included in this one. You follow? If you make an assumption, you'll run into trouble. Only account for the information that is given. Don't assume anything in accounting. Because accounting is not an assuming business. We leave that to lawyers, economists, and such people who are always speculating and trying to outtalk somebody else. Accountants do not do that. We only deal with what? Facts. No assumptions, No, I thought I saw it earlier. Yes, you did. But does it apply to this one? Find out. If it doesn't, don't do it. Okay, that's how accountants work. But I know you thought. We don't deal with thought. We deal with facts. But my boss said, I don't care what he said. We deal with yeah. But he'll fire me if I don't go with what he said. Then
Absolutely.
show him the what.
Facts.
And if he decides to fire you after the facts, what should you do?
Go to the labor pond.
Yeah, go to the bloody labor board. But don't change your position of fact. Correct?
Correct.
If you see on the invoice $10,000, I don't care if your boss says change it to 17. That's what he sees. That's his problem.
Mhm.
You have to record what you see on the document. Okie dokie. A word to the wise is?
Sufficient.
I hope so. All right. So now we know how to apply the beginning capital balance of 10%. Make sure if it says beginning capital balance, you use beginning capital balance. If it says average capital balance, you use average capital balance. We know how to calculate both of them now. And we're gonna know more because we're gonna practice it from the homework I give you, and we're gonna practice on our own. So when the time comes to answer a question on average capital balance, you wouldn't say, how come we have to do all these numbers? It'll be quite easy once you practice this. Okay. All right. Now we have an interesting situation here. In this example, they decide to pay themselves salaries not of 8 and 7, but rather how much? In the next example, they didn't pay them salaries 8 and 7. How much did they pay?
70,000 for the first person and 60,000 for the second person.
Do we call them persons in this class?
Sorry?
Do we call them persons in this chapter?
Mine and Badillo.
What do we call them?
Partners.
Yeah, partners. Or we can call them by their name, but partners is good because we're studying what?
Partnership.
Absolutely. All right. So one partner gets 70,000, the other one gets 60,000. So when they're paid salaries, how much is left to distribute? You don't see the table?
$10,000 is left.
10,000 is left after salaries to distribute. Now, how do we distribute the 10,000? Well, the next step is to allocate based on interest. We saw that earlier, 6,500 and 6,000, correct? So the total interest then will be how much?
10%.
12,000.
So now the interest is more than what?
The remaining funds.
Yeah, so now they're paying themselves an amount that's greater than the remaining funds. But they still have to allocate it in the partnership schedule. So now, after paying the interest, what is left?
What's left, you said?
Yeah,
We're in a
Deficit, a negative balance.
yeah, a negative deficit balance of 2,500. The question is, we can't leave it like that in accounting. We have to account that has to be zero. So what we do is we take the 2,500 and we share it what?
equally.
Simple. So that negative amount, we split equally and reduce their overall capital by that amount. Do you see that?
Yes, that's a lost.
Yeah, well, they got it earlier in the 10% and the salaries. So the amount that is over, we just reduce the capital by that amount. So we balance the amount of cash that is available to distribute. Does anybody not see how that works? Okay. So for the first part, we have 70,000 plus 6,500 minus 1,250. For the second partner, we have 60,000 plus 6,000 minus 1,250. And if you read the note right at the bottom, you'll see they tell you, notice that the negative balance is distributed what? Equally, because the agreement does not indicate how income and losses should be distributed after salaries and interest are paid. So the thing to remember, if the information or the agreement does not say how an amount is to be distributed, you simply do what? Distribute it equally. Remember?
Mhm.
Absolutely. All right. So the final thing that we'll look at tonight before we
Final,
break, yeah,
8:34.
is 8:34.
Yeah.
Time passes quickly when you're having fun. 8:34. You for real?
Yeah,
For
it
real.
is.
For real.
I felt like it started about 15 minutes ago. This is crazy. Okay. Well, let's just look at this one partial income statement that I promise will break. I'll make it up to you next time, I hope. Okay. So the partial income statement then for the year ended June 30th, 2020. Is that in your book? June 30th, 2020? Sorry, 2011?
Yes,
Okay.
we had
Uh,
2015, but
In 2015,
2015. Okay. So net income in this income statement is equal to how much?
140,000.
Yes. And then we show the salary distribution for partner number one, which is
Salary distribution, 70,000.
interest distribution,
6,500.
total
76,500
minus the negative amount.
gives you 75,520.
So the share net income for partner number one would be 75,250, as we saw earlier in the previous chart. Then partner number two, salary distribution,
60,000. And
interest,
interest on beginning capital balance is 6,000.
total
66,000
minus the distribution of the loss.
gives you 64,750.
And if we add them up, we come up with net income distributed of,
140,000.
140.
is that the total net income?
Yes.
Yes.
Yes. So what happens in the real world when we do the actual income statement and we show the net income at the bottom of the income statement, we'll show net income of 140,000. And then under that, on the same income statement, we'll show the distribution of that income for the partners. Do you understand, folks? So the distribution table that we're looking at is done right under net income in the income statement of the partnership, not somewhere else, right under the net income that is calculated under the income statement. Okay. All right. So I think we have beaten ourselves to death for one evening. We are going to stop there. When we come back, if you haven't read the chapter yet, you now have an opportunity to read it or finish it. When we come back on Saturday, we'll finish the remainder of the chapter, which has to do with dissolution and liquidation. This is a whole different side of partnerships on the other side of the fence. The stuff we looked at the beginning was the honeymoon side, like Jerry. On Saturday, we look at the other side, which is not necessarily the honeymoon. Maybe it might even be equated to a kind of divorce. Okay, dissolution and liquidation, which is what happens when there's a divorce. The marriage is dissolved, the assets are distributed after liquidation to whomever the court says should get what, and if somebody's happy and somebody is miserable. Usually the wife is happy, usually the husband is miserable. All right. So we'll stop there. Any questions before we break? Okay, wonderful. For those of you who are still working on your homework, as soon as the homework is done, please email it to me so that I can receive it. And any questions you might have that had you stuck, that you want to get cleared up or whatever, please make a note of it so we can discuss that on Saturday. All right. If there are no other questions, you guys be safe out there. Remember, take all the necessary precautions. Prevention is still better than cure. Remember, the coronavirus does not discriminate. It doesn't know the relationship how close the person is to you. If they have corona, you will get it. And chances are they will live and you will.
Live too.
Live, live.
So you
Good,
being,
right answer.
so you're being an optimist. That's good. Because not everybody has
That's
been
right.
so fortunate. All right. Don't forget last year in the height of the corona, a father's son got corona and both of them died. Okay? This thing is not a joke. It is very serious.
No respect of person.
No, you can't say this is my mommy. I can hug her anyway because that's my mom. You could say that, but corona does not know that. And if somebody has it, mom or not, somebody's going to give it to somebody, and somebody might be unfortunate enough not to recover. That is an unfortunate truth at the moment with this crazy thing. So be careful. I'll see you guys on Saturday. Be safe. Okay?
Okay, good night.
Good night. Take care.
Good night.
Night.
Good night.
Good night. Jerry's on a honeymoon. Still. I know he can't wait. I know he can't wait to get back to Mrs. Jerry. Going on fun. Enjoy the bloody honeymoon to the Bill Jerry.
Alright, will do, will do.
Don't mind these chicks, they don't have anything to do. Go and do.
Good night,
All
all.
right, good night.
Take care.